Hey, hi, it's Gautam. Welcome back. So, if you're an aspiring equity analyst, you are a young investor, or you're a strategy consultant, then you may find this video helpful. Okay? Because in this video, using a case study, I'll demonstrate how to systematically analyze the business, how to assess if the business has any moat, and then how to think about value. Okay. So the case study demonstration I'll do on a company, on a small Indian software company, which is IRIS Regtech. Okay. IRIS Regtech operates in the same space as Workiva, which is a company which we covered in our last video. Okay. And IRIS Regtech, in a nutshell, what it does is it helps its corporate clients generate regulatory filings, the filings that are filed with SEBI, for example. All right. So in this video, broadly, we'll have four sections. In the first sections, I'll do a quick review of the financials of this company, IRIS Regtech, on Screener. And in that process, we'll have a few open questions, okay, that we'll cover later. Okay. In section two is I'll take you through the framework I use to analyze the business. Okay. And we'll apply that framework on IRIS Regtech. Okay. And in that process, we'll answer all the questions that we had earlier. Okay. So that's two. In section three, I'll take you through the framework I use to assess if the business has any moat. And again, we'll apply this framework to IRIS Regtech. Okay. And in step four, okay, I'll connect everything to value. Okay, how do you think about valuation? And then I'll take you through the outcomes of my DCF valuation. All right. So if you stay right till the end, okay, you would be left with a systematic process that you can use, okay, to conduct analysis, a systematic analysis on any company. All right. So that's the goal of this video. All right. So with that said, let me pull up my screen and quickly review the financials of this company, IRIS Regtech, on screen. All right. All right. So hope my screen is visible. I've pulled up screen. Okay. So it's a IRIS Regtech is a small 500 CR company, trades just under 40 times earning. So optically, this looks expensive if you just look at this multiple. Okay. So let me just move along. Okay. 34%, 35% promoter holding. Okay. Like every other software company out there, every other SaaS business, this company as well has experienced valuation compression of the past year because of AI. Okay. So that's there. Okay. And then if I look at, so these are not the peers of this company. Okay. So if I just focus on IRIS Regtech, okay, the debt to equity ratio, there's hardly any debt in this company. They have been able to reduce a lot of debt. Okay. And the market cap to sales, it's 4. So the market cap is almost 4 times sales. Okay. That's the information that we get. Okay. Let me just move along. Let me just take you through the P&L very quickly. It's a high in the sky review of financials. Okay. So if you see, back in 2025-26, the financials there was lack of consistency in sales. But the past 7-8 years, from March 2020 on, the sales has been growing steadily. Okay. But if you look at the margin, right? Okay, the margin was consistent for the most part, but the last year there has been a significant drop in margins. We need to understand why. That's one of the open questions that we have, right? Okay. Plus another open question that we have is why beyond like 6-7 years, why back in 2025-26 the sales were inconsistent, right? Okay. Those are some of the questions. Again, a question that we need to address later on. Okay. Another observation is that if you look at other income, huge other income, right? In the last financial year and in the TTM numbers. Okay. So we need to understand what is happening. Okay. Okay, because it has, of course, inflated the profitability. Okay. So stock price has, so the 5 years, 16% CAGR, sales has grown 18%. Okay. And yeah, so if I look at the balance sheet, okay, hardly any borrowings right now, hardly any debt. Okay. And bulk of the other income, it seems, has been parked in reserve. Okay. So equity has, of course, increased. Okay. And fixed asset, hardly, of course, it's a very small company, hardly any fixed assets. Okay. A lot of investments and other assets have ballooned. Okay. All right. And part of the reason may be because of, we'll find out later, but maybe it have to do with the other income that they have reported in their P&L, right? But we'll get answers to all those questions later on. All right. Now, if I look at the cash flow from operations, right? Yeah. Now, it looks like yeah, that cash flow from operations has exceeded the profitability. Okay, so money is not stuck in working capital. Plus, last financial year, there's a lot of operating cash flow again because of other income. Okay, and if I look at investments, so again, fixed asset investment, pretty small. Okay, now, so if I move further along, if you look at receivables, of course, it's a software company, so no inventory, there are no payables reported as well. Okay, uh, so the receivable is 2.5 months. Okay, and receivables they have improved steadily. Okay, and if I look at the ROCE, okay, ROCE barring year 2022, okay, if I just focus on the last 5-6 years or so, so barring March 2020 and 2022, okay, the ROCE has been above 15%. In last financial year, of course, it went down again. Okay, so yeah, and the promoter stake is around 35%. It fell a little bit. It has fallen a little bit, right? And not a lot of shareholders. So I mean, this is like high in the sky review of financials. A lot of open questions that we'll attempt to answer. Okay, as to what is really happening in this business. All right, and we'll also try to assess the future potential of this business as well. All right. So with that said, now let me take you to the framework that I use to analyze the business. All right, and then we'll apply that framework to IRIS Regtech. All right, so let me walk you through the framework I use to thoroughly analyze the business. Okay. So the first pillar is industry analysis. Second is fundamentals, and third, of course, is valuation. All right. Now, within industry analysis, you got to get a sense of what is the size of the market right now and how big the market will become in the future. Okay, that's of course something very important. You got to assess the size of the opportunity ahead. Okay, and segmentation, how the market is segmented. Okay? Tailwinds and headwinds. Now, for this company, IRIS Regtech, okay? Tailwinds, of course, the regulatory mandates, right? So every company is required to report or required to have financial disclosures, even non-financial disclosures like ESG. Okay, so sustainability mandates are, of course, a growing trend. Okay, so there are a lot of regulatory tailwinds, uh, and AI also is a tailwind for this business. It's not a headwind. It's in fact a tailwind because, of course, there's a school of thought that AI will automate compliance work. Okay, but in my view, okay, AI is more of a tailwind than a headwind. Something that we discuss at length in the Workiva video. Okay, and we'll touch upon it again in the later part of this video as well. Okay, and then is industry cyclical or structural? What's the nature of the competition in industry? Okay, so as per based on what I've researched, this company IRIS Regtech doesn't have any substantial competition in India per se, but Workiva in the US is of course a big competitor. Then even in the US you have Donnelley Financial Services, so there is competition, but for the most part in India, okay, in India they are the prominent players, and this and IRIS Regtech, okay, uh, it's predominantly present in India, Africa, Middle East. It has presence in the US as well. And Workiva, on the other hand, it has predominant presence in the US and Europe. Okay, so they are kind of they of course they have a bit overlap in terms of market presence, but largely they are present in different markets. Okay, and then value chain. Okay, now value chain is understanding value chain for any business is very important. Okay, now so for this business, okay, what I'll do is I'll take you through how this business has evolved. Okay, since the time it was incepted, since its inception. Okay, that will and then that will help you get an appreciation of the value chain in this industry. Okay, so that is something that we'll do. Okay, and then fundamental analysis. We'll also assess the moat in this business. Okay, get a sense of the quality of the management. Last but not the least, I'll take you to the outcomes of my DC evaluation. All right. So with that said, as I said, let me take you to the value chain. Okay, and for that, how the business has evolved. Okay, for the past so many years. Okay. To analyze any business, I have increasingly started using Notebook LM. Okay, I'm sure that perhaps you do the same. Okay, so it's a real productivity booster. Okay, so I use it to analyze not only annual reports, but earning call transcripts. And in fact, I've made a whole video on how to use Notebook LM to analyze annual reports in depth. Okay, So in this video, we'll of course we'll use Notebook LM as well. So in Notebook LM, I kind of uploaded a bunch of documents going back 5 years for this company. Okay, and then very simple prompt that can you summarize the evolution of this company since the time it was incepted? And I asked it to be a little detailed. Okay, so it gave a good response. So let me flash that response in the Excel file. So this is the response of Notebook LM. Okay, so I asked Notebook LM to kind of summarize its findings in a table. Okay, so if you look at when the company started back in 2000. Okay, it started as a KPU, as a service company. Okay, then it seems there was some partnership with a company called Merrill, which of course we'll get into all of this. Okay, and then subsequently, okay, over the last 10 years or so, it pivoted from being a service company to being a product and SaaS company. Okay, that's the highlight. Okay, and then it seems that it moved up the value chain, so it's kind of expanding its product line. Again, we'll understand that. Okay. And then last, of course, as all the companies, it's also focused on doing something around AI. Okay. So these are the broad phases of the company, how it has evolved. Now let's get into each of these phases. Okay, to thoroughly understand the business of this company and the value chain where the steps in the value chain where it operates. Okay. So let's understand this. All right, so I've pulled open the FY23 annual report of this company. Okay, so this company went public in FY18. Okay, and Swaminathan Subramaniam was the co-founder. Was because he passed away in last year. Okay, so other founder they are leading the company now. Okay, so anyways. So let's take a look at his message in this annual report. It will give us a very good sense of how the business has evolved. It will help us double click into the output of in the Notebook LLM's output. Okay, that we just took a cursory look at. All right. Now, so let's see what the founder is saying. Okay, early days. So let me. So he's saying Alive started as a KPO. Okay, writing a US SEC mandate directing public companies to make their disclosures in open source format called XBRL. Okay, so they started as a KPO. Okay, and one of the tailwinds when they started out was that there was a mandate from SEC. Okay, US SEC is akin to SEBI in India. Okay, that all the public companies they need to make their disclosures in something called XBRL, which is Extensible Business Reporting Language. That was a regulatory tailwind. Okay, okay. Now, so what they did is they partnered with a company called Edgar Online, okay, and they created the world's first database of all the US company filings in XBRL. Okay, so in fact, what they did is they converted all the historical filings, okay, of US companies into XBRL, into this language. Okay, and the benefit of converting everything in XBRL is, of course, because it standardizes reporting. Okay, and it also ushers in transparency and discoverability of information in the digital world. So larger point being, so the world was going digital back in 2000s, okay, early 2000s, right? So that was the key tailwind, okay, and they were recipients of that tailwind that kind of convert everything into digital and in a specific format, which is XBRL. So that is how they started the company. Now, what happened is, okay, when the mandate was rolled out, several public providers in the US, service provider in the US, reached out to them asking if they could partner with them. And then they partnered with a financial printer called Merrill Corporation. This is not Merrill Lynch, this is Merrill Corporation. And what is a financial printer? Okay. See, in the pre-digital era, okay, financial printer, I have the definition here. Financial printer is a firm, specialized firm that produces these confidential financial and non-financial compliance disclosures and documents. That is what a financial printer was, okay, back then, okay, in the in the pre-digital era, in a way. Okay, so largely financial printing has been kind of disrupted now. Okay, but Merrill Corporation was a key financial printer based in the US. So unke saath, so they partnered with Merrill Corporation. What the founder is saying is that bulk of our revenues in the next few years came from helping US public companies, all of whom were clients of Merrill Corporation. okay, converting their 10Qs and 10Ks into this XBRL format as required by the US SEC. Okay, so in a way, they were the captive back office of Merrill Corporation. That's what they are saying. And now it becomes very interesting. Okay, if you read through this, yeah, let me just go left. Things were going well until a company called Workiva, which is a company we covered in the last video. Things were going well until a company called Workiva emerged on the scene suddenly and disrupted the market for compliance solutions. Okay, by the time the established players, the financial printers, okay, all of woke up, Workiva had walked away with a huge chunk of the market. Now this is very interesting. So what they go on to say, what the founder goes on to say is that a client Merrill Corp was taken by surprise as well. Okay, because of course the business was threatened, right? Okay, so then Iris and Merrill Corp, they went into huddle, and then they concluded that it's time for them to kind of move from, let's say, a service-based solution to a product-based solution. So that's what they did. Okay? So they created something called Iris Carbon, which was a product. We'll get into what Iris Carbon is. Okay, right now, when they did that, okay, when they pivoted to products, okay, they realized that uh, they could not be exclusive to Merrill. Okay, right? They cannot be working exclusively with Merrill, so they had to take the hard call of parting ways with Merrill. Okay. Now, of course, if you part ways with Merrill Corporation, what it meant for them is that it would be difficult for them to re-enter the US market because Merrill Corporation gave them access to a lot of US clients. But now that access went away. Okay. So what the founder is saying is that we bite the bullet. Okay. And the founder then kind of tells a small story that when he did that, he was reminded of a story from Mr. Narayan Murthy, who founded Infosys. Okay. Because that moment for this founder was akin to the GE moment for Narayan Murthy. So back what happened in 1995, okay, when Infosys was fairly small, okay, GE was one of the prominent clients for Infosys. It accounted for Infosys' one-third revenue. Okay, so GE asked Infosys to reduce their prices, reduce their rates. Narayan Murthy said, "No, we are not going to do that. We are going to maintain pricing discipline because if you cut down prices for one client, it would essentially mean that you'll have to kind of do the same for largely the other clients as well." And Narayan Murthy didn't want to do that. Okay, so he lost one-third of the company's business when they started out Infosys. Okay, so that was a call that Narayan Murthy took, and the founder is saying that we had to take a very similar call. Okay, so that's what he's saying. It's a very interesting story. And the year was 2013. This is when it happened. Okay, now just quickly recap what we discussed so far in terms of business evolution. Right. So the company started 26 years ago, started as a KPO. Okay, right. Then they partnered with Merrill Corporation, became their back office, and then essentially got access to a lot of US clients and converted the filings of those US clients into XBRL format. That's what they did. Okay. And then 2014, around that time, after they basically broke up with Merrill, they pivoted into products. They launched a product which is called Iris Carbon. And essentially what that product did is, it again did the same thing, okay, which converted the filings into documents into XBRL format. Okay. So earlier they used to do it, let's say, via service, and now they start doing it via product, which could, of course, could scale. Okay. So this is how the business evolved. Okay. Now, post that, okay, post pivoting to products, okay, they are saying they moved upstream. So kind of now let's get into the value chain. Okay. All right. So here I have the value chain for disclosure value chain. Okay. Uh, so the first step in the value chain is that you take in raw data, okay, from your source systems. Now, every enterprise, every corporation will have ERP systems, will have different systems. They generate a lot of financial data, non-financial data. So what the first step in the value chain is, okay, is that you source that raw data. You aggregate that raw data. That's second step. Third is using that aggregation of raw data, you author a financial or non-financial report. Okay. And then you can also have multiple teams within your client, within the corporate client, collaborate and make changes on that report. Okay. So that's step number 3 in the value chain. Step number 4 in the value chain is that you convert those documents into XBRL format. Okay, right? Now, Iris Carbon, the product which this company made, okay, was into this particular step of the value chain. That is, they'll take in products, they'll take in documents which have already been authored and then convert those documents into XBRL format. So they were at this stage of the value chain, okay, at that point in time. Okay, now what they are moving upstream. In fact, 2023, 2022, they are moving upstream. When I say upstream, this is what I mean. Okay, that not only they are converting those documents into XBRL, but also they'll author and get the data from the client system, okay, aggregate it, and then author the report for the client, for the corporations themselves. So they're kind of moving upstream. That's what they're saying. Okay, all right. And then, so one thing that we got to keep in mind is that Workiva, which is the company that we had discussed in the last video, Workiva is present in all the stages already. It's present throughout the value chain. Okay, all right. From stage 1 to stage 6. Okay, Workiva is present in all the stages of the value chain. Okay. However, Iris, okay, when it pivoted to products, okay, it was only present in this part of the value chain. And then it expanded upstream. Okay. Now, which makes sense because I'll tell you why. Okay. Because the stage 4 is not a lot of revenue generating step of the value chain, because essentially you're just converting. Okay. But if you move upstream, then you can have a higher realization, okay, per client. In fact, realization is something that we'll discuss as well. Okay. So Workiva has around what, both of them have around 6,000 clients, Iris and Workiva. Okay. But Iris, okay, Iris, it realizes only what, around 80,000 rupees. That is just less than $1,000, 1K per client on an average. However, Workiva, its average realization is close to 140K. Think about the difference in realization per corporate client. That is not only because Workiva predominantly serves, let's say, a premium segment of the market. That's of course one reason, but also Workiva has been present in all the layers of the value chain. That is another reason why Workiva is able to have such a high value realization per corporate client. Okay, that's important to know. Now, if I go back to the annual report, yeah, so what it says is they also move downstream. Okay, so what I mean by that is, okay, we just discussed that when they pivot to products, they gradually moved upstream, okay, to kind of capture higher value, higher realization per corporate client. Okay, but they also move downstream as well. Again, what I mean by that is, so for that, I will again have to go back to the value chain slide. So if you look at the slide again, stage 7, this is the furthest step in the value chain. Okay. Now, so what it says is regulators, right? RBI, SEBI, okay, they also need, okay, a software to collect and process these regulatory filings. Okay. So what IRIS did, it developed software which would cater to these regulators as well. Okay. So that's what they did, IRIS. Okay. Now Workiva, just to let you know, is not present in this part of the value chain. Okay, because Workiva only caters to enterprise or corporate clients. It doesn't cater to the regulators themselves. So that's something that we got to keep in mind. Now we've concluded the business evolution and the value chain, but one thing interesting that I found in the annual report before I conclude what we've discussed so far is that you look at the snippet which the management is highlighting, which the management is saying employees made huge sacrifices by taking salary cuts and agreeing to defer the salaries to keep the company afloat when they were transitioning, when they were pivoting to products. Okay, then and when they lost those US clients, it was a difficult period for the company, and the employees, they took salary cuts. And in fact, the founder himself, he's saying, I also stopped taking salary altogether, announcing that I would not draw a salary until all the employee dues are cleared. So this speaks to the integrity of the management. It's of course subjective, but again, it's heartening to see. All right. Now, with that said, let me go back to the framework slide and conclude and just do a status check on what we've covered so far. All right. So we've So we just discussed that this company, IRIS, is trying to expand their TAM by moving up the value chain. Okay. All right. So that's something we discussed in the last video on Workiva. I gave you a sense of how you could go about estimating the size of the market. Okay. All right. So any company, any regulated company, okay, would kind of fall in scope for IRIS. Okay. If you think about it. All right. Yeah. Uh, so that's one. Then tailwinds, of course, the ESG mandates, the regulatory mandates, they are tailwinds. AI, again, as per my understanding, is more of a tailwind than a threat. Yeah, because companies, if you have AI making reports, these important critical reports for you, and if the AI hallucinates, then the cost of that hallucination is very high, right? So you would need companies like Workiva and IRIS kind of do that work for you and not kind of automate it using AI. So I believe AI is only going to drive demand for their software and not kind of pose a threat. Okay. And then competition is something that, again, I touched upon already, and value chain is something that we discuss at length right now. Okay. So this is on the industry analysis. One thing which I should have also stressed when I discussed the value chain was, let me again, I apologize, let me flip back to the value chain just for a little bit, and then I'll come back here. Now, I know we just discussed the value chain. One thing which is important is I said Workiva is present in all the stages. Okay. In fact, one of Workiva's core strength or core positioning is that its clients, the corporates, the enterprises that it serves, okay, they can always at any point they can validate whatever is there in the report. As in the reports that are produced and filed by Workiva, they are always audit grade. Okay, audit grade. Okay, and then the data points in those financial, non-financial reports are traceable from source to, let's say, destination. Okay, and Workiva, the entire positioning is around it being a connected platform which builds these traceable audit grade reports. Now, IRIS, I know it's kind of expanding upstream. It has, in fact, already expanded in the last 2 years or so. But what I found is that there is less commentary, relatively less commentary on this step of the value chain in the case of IRIS. Okay. All right. Because, and this is an important distinction, because any large enterprises, any large client would always want the reports to be auditable and traceable at all times. IRIS also does speak about it, but I'm just saying that IRIS's positioning is not a whole lot focused in this aspect, although they do claim that their reporting is also audit grade. I just wanted to kind of highlight that point. Okay, so any large client, any enterprise, okay, would be ready to pay a premium for audit grade reports. Okay. All right. Now let's discuss the company's fundamentals at length. Okay. And then we'll assess the moat in this company. Okay. Right. Now, for assessing the financials, okay, let's review the earning call transcripts. Okay. So again, Notebook LM came to my rescue. Okay. So let me pull up Notebook LM. If you're a budding investor interested in learning thorough fundamental analysis and valuation, or if you're an aspiring equity research analyst, financial analyst, or a consultant who's interested in learning these skills to get into such roles, okay, then I have a program suited to your needs. Okay? In my equity research and valuation learning program, I cover quality and well-researched content. I cover diverse industry business models. Okay, and I have a growing community. Okay. So, and I also have the list of topics which I cover, which on the slide, which will help you become a well-rounded, thorough analyst. All right. So get in touch if you interested in learning more details about this program. All right. Thank you. All right. So this is the prompt that I gave Notebook LM. In fact, better visible here. Okay. So you're acting as an equity analyst. Your task is to aggregate insights from management commentary and annual reports of this company over this period. What I'm looking for is identify trends, highlight what has changed and what has persisted and why. Okay. And I do not need a summary quarter by quarter. Okay. And I want the insights aggregated into a table with the following columns. Okay. Of course, year. And then I want to understand growth, how the growth has evolved, reasons behind accelerating, deaccelerating growth. Same thing for capital expansion, margins, working capital, any operating metrics. So if you go to any company's investor presentation, you would understand what are the operating industry, what are the operating metrics relevant to that industry. So you ask Notebook LLM to find out, to kind of go back in time and find out as to how those operating metrics have evolved over time and what is the reason behind that those operating metrics have trended a certain way. Okay. So, and then last but not least, I'm asking Notebook LLM to uh, take a look at the earning call transcripts and provide me what is the guidance the management has given, okay, and have they achieved those, have they achieved that guidance over time? And let's say if they have achieved it, then green dot for achieved, and then red for missed, okay, and so on and so forth. All right. And then lastly, I'm asking Notebook LM to focus on the business strategy, on any product launches, acquisitions, etc., and eventually give me an assessment if the management is aggressive or conservative. Okay, and then a summary. All right. So this is my prompt that I gave Notebook LM. Okay, and it returned with this output in a table. Okay, and then you would see some reds and greens on the right. So what I did is I copy pasted this table in an Excel for ease of readability. So let me flip back to the Excel file. Right. All right, so here in this Excel tab, I've pasted the results of the Notebook LM in this Excel tab. So the colors of those dots, the green, the red and the green, did not come through on the Excel. Okay, so I pasted them manually. I put colors manually in this Excel tab. All right. So if you see in the first 2 years, they did not meet the guidance, but in all subsequent years they did meet the guidance. So that's a key highlight. Okay. Now I'll not bring you through all the line items here. Okay. I'll just take you through some of the important ones. All right. Okay. So one thing that's important to understand that see, they have one business. Regtech is the business in which they make revenue from corporate clients. Okay? That is a key driver for them. Okay, and from that business they make subscription revenue. Okay, that business is called Regtech. Okay, so they make subscription revenue from their enterprise corporate clients. Okay, and the metric that they report for that business is ARR. That's annual recurring revenue. Okay, so if you see, ARR has increased consistently. Okay, but in FY26 there has been a fall in ARR. So that is something that we'll understand in a bit as to why that happened. Okay. Now, if you look at revenues, overall revenues, okay, so FY22, there was the revenue growth was lackluster. It was because because the revenue from regulators, it dried up a bit because regulators, they were focused on pandemic management, on economic revival following the pandemic. So revenue from them dried up, but then they continue to make revenue from enterprise clients, from corporates, right? Okay. So that's one. Okay. And then if you look at, let's first take a look at margins. Okay. Margins, of course, FY22 margins also fell because, of course, revenue fell, so margin also fell. So operating deleverage. And then FY23, operating leverage kind of kicked back up because they had a revenue recovery. Okay. And so revenue margin has been increasing, but in FY26 there was a dip in margins. Okay. And so what they're saying, the dip in margin is because of upfront investment that they have to do. Okay, and plus in R&D. Now, if I talk about capital expansion, okay, and debt. Okay, so debt has been reducing. So if you see, I don't know why they've placed debt equity under working capital, but anyway, so debt has been reducing. And in fact, they divested a business in FY25. So they had a business dedicated to tax. So they divested that business for 150 CR. And that's important because the market cap of this company itself right now is 500 CR. Okay. So the amount of divestment is pretty significant when you compare it with the market cap right now, or even the market cap which they had, let's say, a year and a half before. Okay. So that's something. And so it's important that we find out the reason for divestment, right? So let's ask Notebook LM as to why there was a divestment, okay? Why they divested that business. Why was tax business divested? All right. So this is the reason behind the divestment. Okay? Several factors. High capital requirement to scale globally. So they are saying the IRIS had successfully built a strong domestic position in India's GST compliance tax business. Okay, but scaling it globally would have required substantial ongoing investments. Okay, so rather than tying up valuable capital in an asset requiring high capital outlays, high cash outlays to compete internationally, they chose to monetize it. I think it's a very sane, judicious thing to do. Okay. Then the second point is the domestic tax business. Okay, had intense pricing and competitive pressure. Okay, profitability faced a lot of headwinds. Okay, and the segment reported an EBITDA loss. So essentially, they got rid of a loss-making business. So it makes all the more sense. Plus, there was a lot of competition in that business, right? Yeah. And then divesting it allowed them to focus on their two core business, RegTech, which is the core business, which the enterprise clients, and the subtech, which is the business the money that they make from regulators. Okay. So it allowed them to kind of focus on these two businesses. All right. And then it strengthened the balance sheet with non-dilutive capital because they were able to raise 150 CR worth of cash. Okay. So it's non-dilutive capital using which they can fund growth. Okay. And then, yeah, if you see, as I was saying, they were able to sell it for 8.8 times sale. Okay. So that business made probably a revenue of what, 17 CR, and they sold it for what, 150 CR. Okay. So it was they sold it a very attractive valuation. Okay. So this was the reason behind the divestment. And I think it's a very masterstroke in capital allocation. Okay. Right. So yeah, so this is on capital allocation. I think very judicious allocators of capital. All right. So I think for the most part we've covered the key insights from this table. Now also let's look at what else this notebook LM has to say. So in my AI prompt, if you recall, I'd also asked it to prepare a summary, okay, and focus on strategy, product launches, acquisitions, and also assess if the management is aggressive or conservative. All right, so let's see what did the Google Notebook LM return with as a response. Right, so let me go down this table that we've already covered. Okay, so in terms of the business strategy, okay. So again, they pivoted from KPO to a high margin product-led SaaS company, which we've already covered. They divested this business and to focus on the other two businesses. Okay. Right. And then they've also expanded the capabilities of Iris Carbon. They've moved upstream. Okay. That's what they have said, which we've already covered. And management stance, they think from a strategy lens, they are aggressive. Okay. But from financially, they're conservative. That is the kind of management I like. Okay. So management is aggressive in their vision in competing directly with market leaders like Workiva. In fact, management has said multiple times that they would they look to Workiva as an inspiration. Okay, company that we covered in the last video. Okay, and they have a target of 35% annual growth in ARR. Okay? But financially, they're conservative because they are trying to deleverage, and they have been able to deleverage almost completely. Okay, and they've prioritized non-dilutive capital, that is divestments, to over-issuing non-equity, just so that they're able to preserve and promoter interest. Okay? Very smart thing to do. Okay, all right. Now, in terms of summary, okay, IRIS has entered its next chapter characterized by a cash-rich balance sheet, okay, and a concentrated focus on global scaling, okay, SaaS scaling. While the FY26 operating profit might decline and might alarm short-term investors, it represents a classic SaaS J-curve investment base. J-curve because first you are below the profitability line. Okay? You're making losses, then gradually you kind of make profits. In the US, many times people refer to this as the hockey stick as well. But anyways, J-curve is what they're talking about. So the company has moved. So the company has moved from being a vendor to being deeply embedded in the regulatory architecture of its clients. The key remains the lumpiness of the business that they get from. So that's the key risk, the revenue that they make from regulators, which is the subtech business. That business is lumpy. That's not subscription revenue. But the money that they make from enterprise clients, for the most part, that's subscription revenue. Okay, so that's what they go on to say. Okay, right. And in terms of future guidance, what they've stated is that over the next 3-4 years or 5 years, they plan to scale to a revenue 500 CR. So right now they're at 130, 140 CR. They plan to scale to 500 CR in 4-5 years. That's pretty ambitious, actually. Okay? That's what three times. Okay, so it's pretty ambitious growth. And so they're planning a growth of 35% on SaaS business. Operating margin, they expect the margins to expand. Okay, and their capital stance has been frugal. All right. So this is the guidance. Okay, in the last 3 years, they have consistently met the guidance. Now I think we can answer all the questions that we had when we reviewed the financials of this company. Okay. I'm just making sure my screen is getting recorded, right? Yes. Yeah. So the first question that we had was, yeah, that why the lumpiness in revenue, why the revenues were inconsistent. Now we know because they were a totally different company, probably until 24, 25, and then they pivoted to products, and now they are moving upstream. Okay. And in terms of fall in revenue, okay, in the latest year, that is because they are investing for the long term. Okay. So that's why they've incurred a lot of expense in R&D and in sales and marketing. Okay. Why other income? What is the reason behind other income? Because they divested the tax business. Okay. So that is hitting their net profitability. Okay. And also it is reflected in the reserves and in the other assets. Okay. Right. So that's why there's a huge asset base expansion. That's because of the other assets. Right. So it kind of explains all the answers, all the key questions that we had when we quickly reviewed the financials on Sweden. All right. All right. Now, in terms of where we are, so we looked at financials. Okay. All right. Now, before we get to the valuation, okay, let's try to assess if there are any moats in this business. All right. Okay, based upon whatever we've seen so far. Okay. See, I'm following a script. I'm following a structure. That's something that is something that should be taken away. Many times, people, analysts, investors, equity analysts, strategy consultants struggle in terms of streamlining their research. So, to the extent possible, I'm trying to equip you with a structure, with a framework, okay, with a streamlined tarika that you can use to analyze and value your business. All right. Okay. So, anyways, let me go to the moat assessment. All right. So I have the moat assessment framework here. So let me first take you through it. Okay. So see so I have the drivers of moat listed here. Okay. So if a company is able to, let's say, drive both growth and ROIC, okay, for a significant period of time, then that company is said to be demonstrating that it has moat. If you believe that a company would be able to deliver on growth and ROIC for years to come, then that business will be able to do so because it has certain competitive advantages vis-a-vis other players in the industry. Okay, right? And so think of growth and ROIC as the lagging indicators of moat. Okay, and these drivers of moat, think of them as the leading indicators of moat, leading indicators. Okay, all right. So let's review these indicators very quickly, okay, one by one. All right. So first, let's talk about cost advantage. See, they have been the guidance that they've given that they'll be expanding the margins. Of course, there was a fall in margin in the last financial year for the reasons that we have discussed. Okay, and if I look at Workiva has been demonstrating excellent operating leverage. They have been expanding the margin pretty consistently. Okay, but one of the factors that works for IRIS and works against Workiva is that in IRIS, of course, you have the benefit of cheap labor in India. Okay, but that benefit kind of gets offset because the upstream expansion, the value chain, because IRIS has expanded upstream in the value chain, so that they have done using, let's say, software from Microsoft. Okay, now so they have of course have to pay Microsoft fees. Okay, but Workiva on the other hand, again, it's my understanding. Okay, that Workiva, for the most part, they've built it in their own ecosystem. So Workiva, in a way, is kind of saved from that fee. So my larger point being that, in a way, the cost advantage and the labor advantage that IRIS has is slightly offset by the vendor fee that IRIS is being made to pay. But any which ways, let's see how this cost advantage plays out in the future. Let's see if they are able to walk the talk in terms of delivering on margin expansion in the future. All right. So this is something that, of course, we need to keep tabs on. I would say capital allocation. They are very good allocators of capital. Okay, they have demonstrated that already by divesting the loss-making business, divesting the capital-intensive business, which was the tax business. All right. So very good allocators of capital. Okay. Product differentiation. I would say, if I talk about Workiva really has been able to demonstrate that they have a differentiated product because they positioned it that way, that there is a connected product. Okay. which produces audit grade disclosures, traceable and audit grade disclosures. Okay. They also have that commentary, but I feel that they perhaps could focus more on that positioning. Okay, is what I'm saying, right? And I would really call IRIS product as being differentiated when I start seeing increased realization per customer, per enterprise customer, per corporate client. So right now, if you recall, they are making just close to $1,000 per corporate client. I'm talking about IRIS. Okay. However, Workiva is making close to 140K per corporate client. Okay. Again, they serve different segments of customers. Workiva is focused on premium customers across US, Europe, UK, and IRIS is focused more on India, APAC, Africa. So huge market, but they certainly, if this kind of starts expanding, which I believe it will, then it will be a proof point of there that the product is also has some differentiation. All right. Now they have good distribution IRIS, okay, because they have a lot of scale. So and if I talk about switching cost, again, switching cost is something that is of course working beautifully for Workiva, okay, because the kind of entrenchment they have. Again, for IRIS, this is something that we need to see because they've just expanded up the value chain a couple of years ago. Okay, so as you expand up the value chain, only then you would have a very good enrichment across your corporate clients, right? Okay, but I think this, so this is something that again we'll have to keep a close watch on. That if they are able to demonstrate a high realization per corporate client, then switching it will reflect in switching costs as well. In terms of we have already covered competitive rivalry. Not a whole lot of competition in India as per what I have researched. I'm talking about India, but of course, internationally, there is Workiva, which they take inspiration from. And there's Only Financial Services and some other smaller players as well. Okay. And if I talk about threat of substitutes, in my view, AI is not a substitute. As much AI is not going to automate compliance work. Okay? Because compliance is important. There's a cost of compliance. If you don't comply with certain standards, there's a huge cost that you need to pay. So that's something that I don't think the AI is a substitute. AI is a more of a tailwind than a headwind. All right. This is in summary some of the my assessment on some of the drivers of Moat that I've listed here. Okay. So extent allocators of capital cost advantage hopefully will play out. Switching costs is something that we'll see how it plays out. Uh, I'll be laser focused on how they expand realization per corporate client. Okay. Land and expand, as we called it in Workiva. If that happens, then of course, not only it will lead to growth, but also ROIC expansion. Okay. All right. So a lot to keep tabs on. All right. Okay. So, but if you believe in the story, okay, then it certainly is a very interesting company. Okay. Now with that said, let me take you through the outcomes of my DC evaluation. Okay. Of course, I've made some assumptions. Basis assessment of mode, basis whatever we discussed so far. All right. If you're a budding investor interested in learning thorough fundamental analysis and valuation, or if you're an aspiring equity research analyst, financial analyst, or a consultant who's interested in learning these skills to get into such roles, okay, then I have a program suited to your needs. Okay? In my equity research and valuation learning program, I cover quality and well-researched content. I cover diverse industry business models. Okay, and I have a growing community. Okay, so, and I also have the list of topics which I cover, which on the slide, which will help you become a well-rounded, thorough analyst. All right. So get in touch if you interested in learning more details about this program. All right. Thank you. See, to value any business, right? Okay? To value any business, okay, you need to make assumptions in growth. Okay, you need to assess or understand or make a judgment on how the business could grow in the future. Okay, and then ROIC. So in turn, ROIC is made of margin and capital efficiency. So you need to make a judgment on how the margins would unfold in the future, and also how the capital efficiency, the reinvestments, both in terms of capex and working capital, how those reinvestments would, let's say, pan out in the future. Those are the key assumptions that you need to make to value any business. Okay, right? So let me now take you through what I've made, what assumptions I've made. This we discussed so far. All right. So I'm flashing my model. Okay. So I have not gone full throttle. I've not modeled all the three financial statements. Okay. I've done a quick valuation because of paucity of time. Okay. But anyway, let me walk you through what I've done. Right. So see, the management has indicated that by next 4-5 years, they would be able to get to 400-500 CR revenue. So I'm not that optimistic. Okay. So I have assumed a slightly lesser growth rate. I could go bottoms up, but again, positive time, I've been more top down, right? So I'm assuming that this would be their revenue, that they would fall short of 500 CR in the next 4-5 years. Okay. But then they would continue growing steadily. All right. Okay. And in terms of margin, I assume that for the most part, they would be able to demonstrate the kind of margin expansion for the most part that Workiva is already demonstrating. Okay. That's one key assumption. Okay. And in terms of reinvestments, okay. Now, see, they have received what, 150 CR worth of cash, right? Liquidity. So they intend to deploy kind of most of it in R&D, in sales and marketing, etc., etc. Okay. Of course, a lot of it would reflect in margins, but again, the R&D portion, okay, would be capitalized. Okay. So if I assume that, let's say, a bulk of that money of 150 CR is reinvested back in the business for the next 4-5 years. Okay. So that is what I've assumed. Okay? So they don't have to take debt, okay, to kind of fund reinvestments back into the firm. Okay. So that is one key assumption that I've made. And using all these three assumptions, the ROIC that I've got is around, so if you see, my ROIC is kind of inching gradually from 12-15% to as high as 25 under 30%. Okay. Because I believe if the story plays out, then they will be able to demonstrate not only growth, but of course, a very good return on capital for the next few years or so. Okay. So that's my assumption. So I'm assuming that the business will be able to demonstrate some moat. Okay. Because they at least seem to be in that place right now. Okay. But of course, if that doesn't happen, if the margins don't come through, if the growth doesn't come through, then the story, of course, falls flatter. Okay. So you please you act accordingly. All right. So assuming all these things play out, then the fair value of this business is very close to what the firm is trading at right now. The share price right now, the market cap right now is 500 CR. Okay. As per my evaluation, the fair value is pretty close. It's around 460 CR. I would not read much into the 9% difference. I would say the most part, using my assumptions, I find the business to be fairly valued. With the assumption, assuming that they are able to demonstrate growth, they are able to, let's say, have a higher realization from their existing customers in Africa, in India, and of course, they are able to deliver on margin expansion. Okay. So if this plays out, then the business is fairly valued. And this could be placed to compound over the next few years. Okay. But of course, I've already emphasized a lot on my assumptions. All right. But yeah, very interesting business to keep a tab on. Okay. All right. So I hope that was helpful. Okay. If I were to just go back just do a check on the framework. Okay. So I think we've covered everything now. Okay. So we first looked at the industry. Okay. Okay. Got a sense of the size of the market, just as high level sense. We spend a lot of time in understanding the value chain. Value chain is key to understanding any business, right? We spend a lot of time in fundamentals. Okay, we assess the earning call transcripts using Google Notebook LM. Okay, we assess moat in a business. Okay, and we concluded there could be moat in the business provided the company is able to demonstrate demonstrate increase in margin and is able to deliver on growth. Okay, so but there are certainly a lot of factors seem to be falling into place for this business. So let's see how those factors they unfold in the future. Okay, and then we also valued this business as well, and this is our assumption the business is reasonably valued and could be a compounder in the years to come. All right. So anyway, I hope this was helpful. Okay, please write to me if you have any questions, and if in case you are interested in learning a very structured methodology, very streamlined tarika to learn equity research and valuation, financial modeling, then yeah, please feel reach out to me. All right. Okay, I'll be happy to help you. All right. Thank you. If you're a budding investor interested in learning thorough fundamental analysis and valuation, or if you're an aspiring equity research analyst, financial analyst, or a consultant who's interested in learning these skills to get into such roles, okay, then I have a program suited to your needs. Okay? In my equity research and valuation learning program, I cover quality and well-researched content. I cover diverse industry business models. Okay, and I have a growing community. Okay, so and I also have the list of topics which I cover, which on the slide, which will help you become a well-rounded, thorough analyst. All right, so get in touch if you interested in learning more details about this program. All right, thank you.